Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have John McCartney, Managing Partner at Artesian Capital Management, Karl Zeller, Senior Investment Specialist at SS&C ALPS Advisors, and Tejas Dessai, Director of Thematic Research at Global X ETFs. We're here to discuss getting investment exposure to the energy transition. It is great to have everyone with us. Welcome to Trade Talk. Certainly a timely topic with Climate Week NYC taking place the 21st of September. And John, we'll kick it off with you. I think we can all agree that the role of the energy transition is critical at this point.
Yes, especially with AI sort of coming on board. It's a real push for more power sooner rather than later. And it's a sort of global race to who can get the most power online as soon as possible.
Yeah, it's interesting that the electronification theme and AI in general is really what has reinvigorated and is the catalyst behind climate tech.
Yeah, absolutely. If you look at AI and data centers, they've certainly been a big contributor to that, but it's not the only contributor. So certainly switching from conventional fossil fuels to renewables, but we also have other areas like non-AI, cloud computing. We have some consumer trends, switching from ICE vehicles to EVs, and we also have reshoring of manufacturing here in the US, which are all contributing to a tremendous amount of power demand growth that we haven't seen in quite some time, really since the 1950s and 60s with the introduction of air conditioning and refrigeration. So we've grown at about 0.4% for the last 20 years. We're expected to grow 8% by the end of the decade. And another 15%, number gets taken up to 15% if you layer in some of these trends like AI and data centers.
Yeah, and Tejas, it's interesting because it's also a race for leadership and innovation as well, and our competition is quite ahead, according to your notes here.
That is true. I think if you really take into context what is happening here, the US utility industry or power industry hasn't seen any growth over the past couple of decades almost. And looking ahead for the next 15 years, we need to produce almost 50% more power to power AI data centers. You have the electrification of vehicles also into that mix. You have, again, power intensive manufacturing. When you think about semiconductor manufacturing specifically, the amount of power that is needed to produce these chips that we're producing here in Arizona and all over the US increasingly. So when you square all that and compare against how China has grown its power production capacity by almost 10 times in the last 20 or so years, you're starting to look at electrification as not only a growth theme, but also a national competitiveness theme. And I think that is the approach that investors need to take when they're looking at the space.
Yeah, because if the demand is there, it'll be satisfied.
Absolutely. I think what
versus
we need,
policy driven.
Yes, I agree. I think what we need to make sure is that we produce, again, 50% more power, and I don't think that it's going to be just one solution that really delivers all of that power capacity, right? And I think what you need is a unit economics driven case where we need to be able to produce this power cheaply. I think there is going to be data centers that are natural gas powered, and there's going to be data centers that are also solar technology powered, and that combined with battery storage technology and also wind power. So again, it's an all of the above approach that needs to play out here. And from our perspective, we expect at least $1 trillion capex cycle that goes into building all the infrastructure that is needed over the next 10 years for this power production.
Right, and you also have to think about financing this as well. We're talking about trillions of dollars here, John.
Yeah, that's right, and that's why I think the bond markets sort of supply that capital that's required to reach this sort of scale. I mean, equity is obviously going to play a part in doing that and getting project finance sort of off the ground. But at the end of the day, it's going to be the deep liquid bond markets globally that are going to be financing this transition.
Why is it more attractive for investors to look at the bond market versus other types of investments?
Well, bond markets in general are more risk averse than doing equities. But obviously yields have backed up since the COVID period and now offer a attractive risk return profile. And for what we're providing in our ETF, it's not only just risk return that we're offering, but also carbon abatement metrics so that people can see how much renewable power is actually delivering on CO2 management.
So, Karl, how do you think about it in terms of your portfolio and a comprehensive exposure approach to electronification? Is it all eggs in one basket, or how do you think about that?
Yeah, so what we didn't want to do is provide redundant exposures that investors may already have in their portfolios. So take like a large cap EV company or a chip company. And what we wanted to do is give exposure to the beneficiaries of this build out of the infrastructure here in the US. So think engineering and construction companies, think utilities, think all of the wiring and components that get power here into this studio. That's what we wanted to provide, was that comprehensive exposure to the space. So you end up with roughly about 40% allocation to utilities in the portfolio, across 5 broad market sectors, 18 different sub-industries, again, where we wanted to provide that exposure to help complement, not overlap, with investors' portfolios.
Right, and Tejas, let's talk about that from the electronification perspective. Or is it just utilities within a portfolio, or how are you thinking about the mix there?
Yeah, I think when investors are looking to get exposure to this space, I think the first option that they have is look at a sector-focused fund or a sector-focused ETF like XLU. But the problem there is you only have utilities, and again, those utilities are not necessarily in the power business as well. So we think a thematic approach makes more sense. You need to look at, again, the conventional electricity producers, but also alternative electricity producers, a lot on the wind power side, a lot on the solar power side, as well as other innovation that you're seeing on the nuclear power side as well, which is very important. And then look at the long tail of infrastructure, right? The transformers, the poles, the wirings that we're talking about, also cooling systems and a breadth of solutions. So we're combining all of that in our thematic offering that we brought to market. ZAP is the ticker there. And we've seen tremendous interest. In the last 12 months, we've seen almost 170 million in net new assets in that fund since launch here, and remains one of the popular thematic successes for us in the last year.
Yeah, let's talk about the energy transition more holistically. John, do we have the skill set and the ability to achieve what are some really lofty goals? What's your outlook in general?
Well, I think the capitalist market system is going to provide it. Like the way that sustainability is working into both the top and the bottom line for corporates means that over time we will achieve it, just because it is the most efficient way to do it, if you like. So I believe over time we're going to see the transition happen organically, because that's where capital will flow.
Yeah, I mean, it's also going to start to impact the capital markets in general when you think about M&A and different types of companies accessing the public markets too.
Yeah, so we have, I would say, our exposure, we give investors exposure to mid-cap companies and smaller large-cap companies, so that we could start to see that play out in some of those smaller cap names within the industry there in terms of M&A, because this is such an important area and focus for capital markets and companies.
Yeah, it's almost like the macro environment, not that it doesn't have an impact on it, maybe with the exception of interest rates when we think about small and mid-cap companies, but it's it seems as if there's really nothing stopping it here. We're basically operating in a bottleneck at this point.
We are. I think energy and power is the bottleneck for the AI story to unfold right now. I think 12 months back it was chips, but since then we've produced a lot of the chips that are needed, and now it's about where can I get access to the grid and access to power to really bring these facilities, data centers essentially online. And I think the good thing here is you have large technology companies whose business models essentially rely on getting access to power and are now getting into these deals with power producers as well. Right? And that opens up a lot of new capital within the space, which supercharges capital. But I think with potentially rate cuts, cost of capital coming down, we could also see more private equity or other forms of capital coming into the space as well that drive the story forward. So again, look, this is a demand story. We've never seen catalysts this strong in the past, and I think there's going to be plenty on the table for these companies to go after.
Yeah. It's interesting because data center demand, you would think that it would be a big piece of the pie, but it's not even, it's a single-digit percent. I mean, granted that it's expected to double by 2030, but you would think because AI is such a significant driver of the climate tech and investment story, it would be a bigger chunk.
That is correct. I think it really goes back to what we're seeing here with artificial intelligence. Every single ChatGPT query consumes almost 10 to 15 times more power than Google search. So from a computing standpoint, this is a complete regime change in terms of how these systems essentially work at the fundamental level. So they need a lot of power. If you look at data center consumption of US electricity demand, we were at roughly 2%-ish in that range when ChatGPT came on the scene. And now we're looking at 10 to 12% at the end of this decade. Again, massive shift that needs tons and tons of investments to really power these facilities. I don't think any algorithmic improvements that we will see along the way will really bring that power equation down. What it will do is really expand the use cases across the board and really drive that cumulative demand.
Yeah, and we were talking about that off camera too, Karl, in terms of a project that certainly there's resources going into.
Absolutely, yeah. So if you look at a utility based in Ohio, they've received requests for more than 30 gigawatts of power demand capacity from hyperscalers and data centers. And just to put that into perspective, the entire data center capacity around the globe is about 60 gigawatts today.
So it's half?
So it's about half overall, yes. And I think we've seen some research come out where in AI, and a large builder of AI, where they would anticipate 50 gigawatts of power capacity needed in the future. So that's almost double what we have today. So it's certainly going to be a trend that's going to play out over time.
What is 30 gigawatts, basically? Like, what would that power, or how can we contextualize that a bit?
Yeah, it's an enormous amount of power. I would say, the largest data center that's being built in the US today would be the equivalent of powering about 375,000 homes, and that's about 500 megawatts of power needed today. So you're talking about a very large.
Yeah.
But it's also a strategic asset. You've got to remember that India and China are pushing the edge of the envelope in terms of the transition faster because they don't have the fossil fuel assets to be able to draw on. So they're pushing the edge of the envelope in terms of the transition because they see it as a strategic asset. And not only just for general power consumption, but they see it as a strategic asset in terms of defence.
Right.
And what we're seeing playing out in Ukraine is that having long lines of diesel powered tanks isn't the way of the future. It's going to be drones, it's going to be robots. So I think that that's also another significant draw on what's happening.
Yeah, I think it's a great point that you make, especially when you think about other themes that tie into that, whether it's defense tech, cybersecurity, and so forth. So, we are in this race for innovation for national security, but it also we have to model out that risk as well. I mean, this is critical infrastructure. We can't afford to have a grid go down.
Yeah, that's right. And what happens if it's easier to target your grid and destroy the whole infrastructure. That's the issue. How do you balance cybersecurity with innovation?
Are you seeing investments being made in existing infrastructure or existing resources such as water or biochar? Or, we know our infrastructure needs to be upgraded here. So whether it's existing or thinking about sustainability and adaptability with newer projects, is that a key concern?
Yes, it is a mix of both. When you're looking at the way most of these data centers are being built, water, of course, is one of the major resources that is needed to power these data centers as well. But some of the adjacent infrastructure, when we think about, again, power lines, when we think about the current electricity distribution infrastructure, most of that is old. And it was built, think about the US grid, majority of it was built in the 70s and the 80s. The average age of a transformer that we have here in the US is about 40 years. So, clearly built for a completely different era that now needs to be, retuned. At the same time, you're also seeing the construction of new power plants, new facilities, new data centers. Combined, I think that is another catalyst driving, infrastructure spending in general. And that's another theme that we see as an offshoot beneficiary of this whole AI, clean energy, as well as the electrification story.
Yeah. I want to go back to green bonds for a moment here, John, just for my own understanding. Are green bonds a designation as well?
Yeah, it's a labelling instrument by the International Capital Markets Association to say, look, this is the use of proceeds when you issue a security. So it's dedicated towards certain eligible projects, most of it being renewable energy, and it allows investors sort of transparency on where their money's going when they, provide money to bond issuers.
Yeah, because it's a popular product globally.
It's about $3 trillion outstanding in bonds, so there's a lot. More so offshore than there are in the United States, but yes, it's definitely a growing market and growing quickly.
Yeah. Karl, looks like you had something you were going to add to that. That you're looking at me for a moment here. I'm just trying to wrap my head around the the electronification theme, and as you think about building these portfolios and adding investments into portfolios and so forth. Just how quickly that methodology could change. What 40 years you were saying before? Transformers are almost out of use as it is. 40 years from now, can we even? What's that going to look like?
Yeah, absolutely. Look, I think we are seeing the demand, and that's going to take a huge amount of infrastructure, not only power, but also infrastructure to support that demand. We're seeing the CapEx being spent by utilities. Mentioned some numbers earlier about, if you look at it, they've spent about $1.5 trillion over the last 5 years. They're expected to spend another $1.1 trillion over the next 5 years, and we're going to get annual grid investment of up to $100 billion per year by 2030. So there's a tremendous amount of capital moving into this space, and there's a whole host of beneficiaries that are going to be able to take advantage of the tailwinds in the space that are going to play out. This is not a theme that's going to be a 2-3 year theme. This is going to play out over decades to come, and I'm sure that that will evolve over time, and we'll see the mix of power change over time. So certainly we have natural gas supporting a lot of the electricity in the U.S. here, renewables coming online. We need battery technology to really come up to speed there, and then nuclear is probably a little bit farther off. So natural gas is a nice bridge, and we need that all of the above approach to support these the investment in the infrastructure going forward.
And just to wrap up here, as we think about beneficiaries, I mean, for the circular economy as well, as we upskill and reskill the workforce, I mean, these are good salary paying jobs, which is only going to go back into the economy as well.
That is absolutely correct. I think, look, when you look at all the sources of capital, you have big tech spending. There are some engineering jobs within these data centers as well that are coming into market. On the cybersecurity side, these are again the jobs that didn't exist 5-10 years ago because of these new use cases and new technologies that are coming to market. But also on the electrification side, on the infrastructure side, these are specialized, skill-driven jobs. And from that perspective, again, I think the spending that we're seeing here is really going to drive not only the economy forward, but really make sure that we operate in a secure world where we have all these technologies and the resources to lead in the technologies of the future.
All right, appreciate all of your insights. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.